Hello everybody, welcome back to the Market Information Lab Valuation Bootcamp. This is week number 3 and we'll be touching on financial topics. My name is Jacob and I will be your instructor for today. So we're going to go ahead and dive on into it. As a review, we've gone over Intro to Excel, financial statements, and the financial topics. That is what we're going to be diving into today. Quick agenda. So we're going to start with introduction to the time value of money. Then we're going to dive into discount rates and net present value, talk briefly about IRR along with Excel practice exercises, and then we'll go and leave with our key takeaways. An introduction to the time value of money. So if anybody has taken Fin 221 yet, you probably have a brief introduction into the time value of money, but we're going to go into it a little bit today because it's extremely important when we're talking about valuation. Essentially, time value of money comes down to one thing. And that is time and its inherent value. So what is more valuable, $1 today or $1 tomorrow? Well, if I offered you $1 today or $1 tomorrow, you should take the $1 today because you have the potential to earn interest on that dollar and at least have, let's say, $1.01 by tomorrow. Now, however, it doesn't always work out to be just like this, but it's important to note that the value of your investment increases over time due to your rate of return. So what is time value money? Essentially what it's saying is the money today is worth more than the money tomorrow because you can earn a return on this, right? So essentially the longer that you hold this investment for, the more valuable it is. So while $1 today versus $1 tomorrow may not make a huge difference, if I was to give you $100 today or $100 a year from now, you would definitely want to take the $100 today because you could earn a significant amount of interest, right? You could potentially have $105 by next year instead of just $100, assuming like 5% rate of return. Essentially, this is a theory and it's not always true. There's a chance that you have a negative return. However, it's important to think about risk and return as far as valuation goes, because this is essentially what you're trying to do when you're building out a valuation model. What are the time value of money equations? Pretty simple here. So your present value is equal to your future value over 1 plus your return to the time, which is t. And if you're trying to project out future value, you would take your present value, multiply it by 1 plus the return to the t. Right, so you follow these simple formulas to give you either your present value or your future value. So this essentially is if you were trying to discount a lump sum payment, right? So if it's either your $105 in the future or $100 today, if you were to go ahead and plug these into each of these formulas using T1 and R is 0.05, you would get the 100 or 105 using these formulas. And essentially, whenever we're looking to value these companies, we're looking at the present value. We're not looking at the future value of a lot of these investments. So it's important to think about things in the present value. So your discount rates. Discount rates, what are discount rates? Discount rates are essentially is your opportunity cost or the rate of return that you're expected to get on the investment. So if we go back to my $100 example, 5% is my opportunity cost of owning that. So if I was to either give you $100 today or $105 tomorrow, or within a year from now, you'd be indifferent between these two options because your opportunity cost is 5%. Now, if I was to give you $108 in a year, you should take the $108 a year because your opportunity cost is 5% and you wouldn't be able to get this return. Now that we add all these different numbers and values into the equation, we can easily see what is a worthwhile investment and what isn't a worthwhile investment. Basically, as we dive deeper into valuation, there's different types of discount rates that we'll be using. Required rate of return and weighted average cost of capital is ones that we'll be talking about today. Required rate of return essentially is the minimum requirement a company is expecting to receive when investing in a project. This is very common whenever you're working with corporate development projects where a corporation is looking to receive maybe 10 or 12% on every investment they make. So if you're valuing a company with the required rate of return at 12%, you would want to make sure that your net present value is 0 or above 0 using your required rate of return. Essentially what this is saying is, with this return, how positive is this investment? Then we also have a weighted average cost of capital. We use weighted average cost of capital when we don't know the required rate of return. Essentially what this allows us to do is take the average return required in an equity and debt investment, average the two, and that gives us our weighted average cost of capital. How do you figure out the average of the two? Well, if you're using equity, you're using your CAPM method. And debt, you're often looking at the newest debt issuance. And weighted average cost of capital tells us what is the required rate of return of the next dollar raised by this company by essentially taking the balances of the weighted average of both of these two. Net present value. Net present value is essentially the current value of all the future cash flows, inflows and outflows. So it's important to think about net present value as you often want this to be above zero. If your net present value is above zero, a lot of the times you're going to be expected to accept the project. You use this to evaluate projects and multiple cash flows, inflows, and outflows. Oftentimes, when choosing between two and using the net present value rule, you'll probably choose the net present value that gives you the highest dollar amount. So if you had one net present value that gave you 10 and one net present value that gives you 20, you would take the project that gives you 20. The net present value is calculated by discounting your cash inflows and outflows by the discount rate. This could be your required rate of return or your WACC. We often use Excel or a financial graphing calculator to calculate Mpv, and you can use Mpv or Xmpp are both formulas that you can utilize in Excel. Now, there are two different types of investments. One is a positive initial cash flow and then a negative initial cash flow. Positive initial cash flow are things like issuing debt or equity, taking out a loan. Essentially what you're seeing is the dollars today. You get the dollars today, and then you have negative outflows throughout the term. So this could be paying off the debt. This could be paying off interest. Another thing is a negative initial cash inflow. This is usually a project or you're investing in something. You see a large lump sum going towards the project at the beginning and then positive cash flows throughout the lifetime. Now, whenever we're evaluating investments, I told you earlier that you may compare Mpvs. So one Mpv may be more positive than the other. We're going to look into, in just a moment, another way that we can evaluate projects outside of just the Mpv. Internal rate of return. What is internal rate of return? Internal rate of return is the discount rate that the Mpv will be equal to zero. Essentially, this is telling us what the actual rate of return that is inherent in this project. Now, instead of looking through all the project's Mpv values, for example, an Mpv value of 200 or Mpv value of 20 you may accept the Mpv value of 200. However, the Mpv of 20 may have an internal rate of return that is higher, and if you're choosing to accept the investment with the highest internal rate of return, you will choose the investment of 20. So it's important to look at both, not only the Mpv, which is the positive present value of this project, but it's also important to look at the internal rate of return. In Excel, we will calculate the internal rate of return using the XIRR or IRR functions. A lot of times when evaluating an investment, it's important to consider internal rate of return and compare it to things like the required rate of return and the weighted average cost of capital. If IRR is above RRR or WACC, weighted average cost of capital, then this will represent a positive Mpv. If IRR is below the required rate of return or WACC, you're going to see a negative Mpv. Some Excel functions. We're going to use these in a moment, but it'd be interesting to go over a brief overview. The difference between Mpv and Xmpp is Xmpp through Excel utilizes the dates. For example, if we wanted to use an uneven cash flow, we'd recommend using Xmpp because Excel will take into the dates and then automatically calculate the Mpv by accounting for the differences in dates and discounting your cash flows accordingly. If you were to, say, use the data earlier provided, for example, you have a year, you have half a year, another year and a half, and continuing on a year, these cash flows are extremely uneven. So if you used Mpv, it would just assume a discount period that is equal or the same. However, this is untrue. We can see that the cash flow period is not equal. It is not a year increment or 6-month increment in between. So we must utilize Xmpv so it will calculate accordingly. Same thing goes for IRR. If we were just to take the IRR of this project, it would assume equal distributions of cash flows. However, that is not the case. So we want to utilize XIRR whenever possible to avoid this potential for uneven cash flows. Now we're going to go ahead and dive into the practice exercise. So hopefully you guys have the practice exercise at home that you can go ahead and pull up. I'm pulling it up here. Should look something like this. You're going to land at a platform, and essentially what we're going to do is utilize the company's WACC to determine if we should accept or reject a potential project. Off to the right-hand side, we have the instructions for building out this project. So the project is going to bring in revenue and expenses additional to our company, right? So you're going to see estimated revenue synergies and then tax expenses. That's what's going to happen in the potential projects. Additionally, we will have cash outflows to go into this project. So the first thing we're going to do is we're going to project out our current revenue in the projected earnings. So what I'm going to do is very similarly to what we did in week 1, equals 1 times 1 plus my revenue growth, enter. Now again, throughout this whole entire time, we've really stressed the importance of using the keyboard and trying to use keyboard shortcuts. So I highly recommend that you follow along with that, as it'll help you get faster at Excel. So in order to drag all of the formulas across, I need to go hit F2 and lock the growth rate. What this will do is allow me to drag this formula to the right while projecting out revenue, but not changing the actual growth rate. So I'm going to click F4, enter. As you can see, this is the same value before, but what this will allow me to do is to drag this formula to the right, similarly to what we did in week 1. Control C to copy, Shift right arrow key, Alt ES to paste special, and F for formulas. As you can see, I just very simply copy and pasted this formula across, and it is always linking to the correct growth rate. Next, we're going to calculate out expenses. We're calculating out expenses as a percent of revenue. So all we're going to do is take our current revenue, multiply it by a percentage to get our current expenses. Very simple process. You follow along with me. Similarly, we're going to equals our revenue times our expenses as a percent of revenue. Again, we are locking this so it allows for simple drag and drop to fill in our formulas. F4. Again, clicking F4 to make sure it says $Q, $8. This is locking the cell in our expenses as a percent of revenue. Control C, Shift right arrow key, Alt ES F to base special, just formulas. Finally, we're going to calculate our pre-tax income. Equals revenue less expenses. Control C, Alt ES F to paste across. Our tax expense. We're taking our tax expense as a percentage of our pre-tax income. Very simply, we're going to do exactly what we just did for current expenses. Equals pre-tax income multiplied by our corporate tax rate, locking our corporate tax rate, which allows us to copy and paste it to the right without having to adjust for this cell. Control C, Shift right arrow key, Alt ES F. Finally, I'm going to subtract my pre-tax income less my tax expense to get my net income. Equals pre-tax less net income, less taxes, copying and dragging this to the right. So I'm going to go ahead and stop here. Feel free to pause the video if I'm going too fast, or rewind. Make sure you're following along. If you have exactly what I have on here, you're just going to wait a moment. Feel free to pause the video if you need help, rewind, watch again. Hopefully you're becoming more comfortable with Excel and your keyboard shortcuts. We're going to continue along here, but please feel free to pause the video, get caught up. You don't want anybody falling behind. Awesome. Now we're going to actually project out the incremental revenue synergies, which means the additional revenue we would estimate from this project. Then we're going to compare that and net that with our cash flows and determine if this is an investment we should accept and what the internal rate of return is. Similarly to earlier, we have some assumptions off to the right-hand side in blue. So our estimated revenue synergies is going to be 20% of revenue, right? So very similarly, I'm going to take revenue, multiplying it by 20%. Again, since I'm always going to be multiplying by 20%, I'm going to hit F4 to lock this. That way it allows me to drag and drop across. Control C, Alt ESF. Now we have the estimated revenue synergies, the extra dollars that we brought in by accepting this project. Although I'm bringing in extra revenue synergies, I also need to consider the tax expense, the incremental tax expense that will be required. My incremental tax expense can be figured out by taking my estimated revenue synergies and multiplying it by the estimated corporate tax rate. Very similarly to earlier, equals my revenue times my corporate tax rate. Locking with F4. Enter, Control C, Alt ESF. Now that we have our incremental revenue synergies and tax expenses, we're going to go ahead and add up to our new additional net income. Very similarly, just going to subtract these two, copy, paste across. Now it's time to net these with our cash outflows, right? So all of these are going to be additional cash inflows of accepting the project. However, there's going to be potential cash outflows. Those are written to the right. So in the first example, this investment will cost us $17,500 multi-million dollars in 2018. So I'm going to go ahead and drop that in here. So I believe this is actually a typo. The 17,500 is actually in 2019, not 2018. And then we're going to have an additional $500 outflow. Sorry, this needs to be negative. Negative outflow of 500 in 2021. So this is whatever is required to maintain the investment. This could be possibly CapEx. This could possibly be potential growth and maybe needing a new building or a new piece of equipment, whatever it may be. This is a cash outflow that is required. So now we're going to go ahead and add up our projected cash inflows, net them with our outflows to then calculate our Mpv and Irr. Our projected cash flows is equal to our new income plus our potential investment. Control C, Alt ESF. So as you can see, there's a heavy cash outlay followed by multiple cash inflows, with the exception of 2021, which is almost zero due to the required reinvestment. Now we're going to go ahead and calculate Mpv. So is this a good project? Let's find out. So if we want to accept the project, we're looking for a positive Mpv. Positive Mpv, how do we get that? We're going to do equals X Mpv, arrowing down, tab to pull up my formula. My rate is going to be the WACC, the company's weighted average cost of capital, comma, my values, arrowing up, shift, highlighting, and then my dates, which is right here. And that is going to give me a negative Mpv. So according to time value of money and the WACC, this is going to lead us to a negative Mpv on the project, which is suggesting that we would reject. Now, going back into what we were talking about earlier today, if our Mpv is negative, I'm expecting an IRR to be lower than the company WACC. So let's find out. Equals X IRR, and my values, shift, comma, my dates. I have a period, not a comma. Shift, highlighting all my dates, close parentheses. And as you can see, our IRR is 8.79, which significantly shows us that our hypothesis and theory was true. Since we have a negative Mpv, our IRR is lower than our WACC. Now let's say the company's WACC was changed. Let's say it's actually 8%. So if the company's WACC was 8%, our Mpv will become positive because the IRR is greater than the WACC, or the required rate of return. And there you go. It turns positive. It is green, suggesting that it's higher than the company WACC. Hopefully this was a great demonstration of the differences between positive and negative Mpv, positive, negative IRR, and with respects to the required rate of return. Now on to exercise 2. Go ahead and click control page down when you're caught up with me right here on the screen. Awesome. On to Excel exercise 2. Now we have 2 different projects. As you can see, both of the projects are very different in nature. One is an investment in possible, like for example, this could be a plant or property, a piece of equipment. You see a heavy negative outlay in the first year, followed by positive outlays in the following year. Project 2 is unsimilar. You see a positive inflow on the first year, then negative outflows. As you can see in one of the line items, this is a debt issuance. We're essentially taking on debt to pay for whether it could be financing for the company. And then number 3, we're going to combine the outlays and the inflows and figure out what the combined projected IRR could be. So starting off, we are just going to calculate our Mpv and Irr. So very similarly to what we just did, equals X Mpv. Our rate of return is 10%. Our values is going to be 2020 all the way to 2027. And then pulling in our dates to account for any uneven cash flows that we may not be aware of. Closing parentheses. As you can see, the Mpv is positive. So if it was just this project, we would go ahead and accept since the Mpv is positive. Now we want to figure out what the internal rate of return of this project is. Equals X IRR, our values, comma, our dates. Close parentheses. As you can see, our IRR is 10.7. 10.7. So if I was to change my WACC to 10.7, our Mpv we would expect to be 0. And it's very close to that. I imagine that it's actually 10.72 or 3, some small nature like that. Some small change, we can get pretty close to 0. However, we're going to change this back to 10%. Now we're going to look at the Mpv and Irr of the debt issuance. So if our weighted average cost of capital is 10%, is this positive Mpv? Let's figure out. Equals X Mpv. Our rate is 10% still. Our values highlighted here. And then our dates appear at the top. As you can see, this again is a positive Mpv, meaning that if you were just to accept this debt issuance and with the weighted average cost of capital 10%, this is a positive experiment, and we should definitely take on this project. Now let's figure out the internal rate of return of this debt issuance. Equals X IRR, and due to the initial positive outlay and then the negative outflows, our IRR, if we're giving a positive Mpv, is going to actually be less than the WACC. So because of the inverse relationship that we're witnessing here with the debt issuance, as opposed to maybe a potential investment or project, which we see in project 1, we're actually going to see IRR be less than 10%. Highlighting my values, similar to before, my dates above. And as you can see, our IRR is 9.2%, which gives us the positive Mpv, right? It's very important to notice and watch for this positive and negative interaction, right? If it's a positive outlay at the beginning and it has a positive Mpv, IRR is going to be less than our WACC or required rate of return. However, if it's a negative outlay at the beginning and you have a positive Mpv, our IRR is going to be greater than our weighted average cost of capital. Now we're going to go ahead and combine both the initial outlay and the requirements and maintenance throughout the period to figure out a combined project. So what if we were to take on the debt to pay off the project number one, combine the two? What's going to happen to Mpv and Irr? Well, let's figure out. Our initial outlay is going to be our 200 plus our 150. Now this formula is dynamic, so I can just go ahead and copy and paste this to the right. Using Control R or Control C, Alt ESF. Next, I'm going to include my cash inflows and outflows. So I'm just going to simply add both of these blank cells here, Control C, Alt ESF to copy and paste the formulas to the right. Now we have our combined cash inflows and outflows. Finally, I'm going to sum up both of these columns using a simple keyboard shortcut, Alt equals. Alt equals. Control C, Shift right arrow key, Alt ESF for formulas. As you can see, now we have the combined cash inflows and outflows of the two projects. While it may not be as heavily positive or as heavily negative as project 1 or 2, the combined will increase our IRR and NPV due to the reduction in the initial outlay that is brought to us by incurring on the debt for the period. Equals X Mpv. Our rate is still 10%. Our values provided here. Our dates provided here. Now our Mpv is significantly higher than we witnessed earlier, just due to adding the debt and the project together. Next, we're going to calculate the XIRR. Values, our dates. Since our Mpv is positive, we're expecting this to be above 10%. And there you go, it is. We see 13.8%. Now, not only is this a good thing to realize that the combination of the two is important, but this is also a great introduction to the use of leverage and how leverage can boost positive returns. For example, Project 1 has a positive NPV, so by using debt capital to finance this purchase, reducing your purchase price, this shows you the possibility and potential for leveraging up your investment to increase your returns. Hopefully you guys were able to follow along and utilize these cool functions. These are going to be extremely important as we continue to progress throughout the financial modeling bootcamp. Now let's go back to our slides to finish up with some key takeaways. Some key takeaways for today. Time value of money can either destroy or generate value. If you do not look at an investment with a rate of return in mind, you could potentially be accepting an investment that destroys value. Two main approaches to estimating a value and its potential creation, right? So comparing IRR and NPV is extremely important. And whenever the projects can complement each other, maybe looking at the combined. We also looked at how companies evaluate projects. Finally, what are some mistakes that you can make and how to avoid them? For example, an Excel calculation with an uneven project periods between can lead to an incorrect formula, an incorrect calculation. So utilizing XIRR instead of IRR can fix this problem. Finally, we looked at how debt can amplify returns. So using debt financing is extremely cash positive if you can pay for the debt. How's this going to play into next week? Well, go ahead and find out. We've covered all the financial topics required to dive deeper into valuation. So next week, we're going to touch on comparable companies and precedent transactions, followed by DCF. It's getting exciting. We're about to get into some of these valuation models. So looking forward to having you join me next week, week 4. Thank you guys.